Good day. I'm Martin Gagel with Market Radius Research. It's Thursday, September the 29th. We've got CEO Andrew Davidson of Royal Helium. Royal Helium is an explorer and developer of helium projects. It's good to have Andrew back. It's been almost 4 months since we talked, and a lot has happened since then with the completion of Imperial, an engineering report, a supply deal, and much more. Andrew's going to give us a brief overview on the company and industry as a refresher and for those new to the story, but we'll focus on updating the recent activities and then open things up for questions from the audience. But please remember, this is neither recommendation or investment advice. We're here to learn about the company. Andrew, thanks a lot for joining us again. It's great to have you back with a whole bunch of news under your belt. So why don't you take it away?
Yeah, well, thanks for the time, Martin, and I'm glad everyone could join today. It's been a very busy 4 months, as most of you who may have noticed if you're paying attention to what we're doing. You know, the world of helium is, well, it's ever changing, and the last 6 months have been a prime example of that. The world's moved from a structural shortage of helium to a severe shortage of helium due to global geopolitics and the invasion of the Ukraine by Russia. As a refresher, Russia is one of the big three suppliers of global helium: Russia, the US, and Qatar. And sanctions put in place in Russia, both on the export and on the import of the materials required to fix their plants, has caused essentially their supply to be offline from a global perspective. So that has caused, obviously, continued upward pressure on the price of helium, which is very beneficial to near-term producers like us and detrimental to all users who have to pay the higher price. But that is what it is. We are moving to soften that gap between demand and supply through near-term production from a couple of different asset blocks. First and foremost would be our Steveville asset in Alberta, which we expect to have online by March of next year, followed shortly by production at Climax in Saskatchewan, and then eventually the Ogema-Bengoff area of Saskatchewan as well. So it has been very busy. We've been focused on de-risking the project and getting it ready for project financing for the building of the processing facilities that will be required at Steveville. And that's one of the reasons that led us down the path of getting that CPR report done, which is essentially a resource report, although we can't call it a 51-101 because it is about helium and not natural gas. One of the main reasons we did that was so that the project would then be bankable, so that the facility itself could be financed in more traditional non-equity based ways. And I'm sure we'll talk about that in more detail in a few moments. But in order to get the CPR in place, we also had to have an offtake agreement signed. And we had been in talks with our partner for quite some time. A little over 6 months was the negotiation process on that deal. And when we got to the point where it was very clear we were going to sign this agreement, that is when our interest in buying Imperial Helium went from very low to very high. And that's why we completed the acquisition, was specifically for this contract. Everything there has worked out quite well. We have a clear line of production that will allow us to meet that contract and in fact exceed the production requirements of that contract virtually immediately. So it's been a very interesting time. All of this we've been exploring into a rising price, as we talked about. The demand side is doing nothing but increasing, and you can really see that from the customer that we are selling to. We're selling directly into the space exploration business, which, as far as we can tell, is one of the first times that that's ever been the case. Traditionally, helium explorers and producers sell to industrial gas companies, who then sell to end users. What we've seen with the decline in global supply is end users coming up market directly to producers to secure volumes directly from the people who own them. And that's a major shift in the purchasing dynamic in the helium industry. So beneficial for us. We're able to charge a premium to what we pay to a wholesaler, and beneficial to the customer, who end up paying less than they would otherwise pay to a wholesaler. So it's a terrific business arrangement, and we look forward to completing more of them. anecdotally, that initial contract accounts for about 40% of our productive volumes, beginning in March of 2023. And, really, that is what we've been doing over the past 4 months, Martin. De-risking the project, getting it construction ready. We have our facility completely designed and engineered, and the contract is awarded. We're moving into construction as we speak.
On the offtake agreement, are there any sort of like you need to produce by a certain time, or what if like something you're late, and do you have to buy off the market to fulfill your obligations, or any kind of potential liabilities like that?
Well, there are no penalties in the contract. The timing is we have to deliver in April. Our initial deliveries are in April. So the timing that we have with it being online and commissioned in March certainly allows for that to be met. Obviously, we would take whatever steps we needed to ensure that we don't miss on our first delivery, whether that is, prepaying in advance for some of these components or whatever's required to ensure the facility is online as scheduled. We actually went with a bit of a different processor design than we had originally considered. We've gone straight to a cryogenic unit for separating helium from the associated gases, and that we've done that for a couple of reasons. One, it was materially less expensive right out of the gate to get it done, and two, it actually allows us to produce 4 commercially viable product lines. So 99.999% helium is obviously the main one, but we'll also produce condensate, methane for power, and food grade CO2. So all of these things have a very active market. The methane, of course, will just be used for power generation at site. So very interesting design. It's not what we were initially considering, but it's just a phenomenal facility. We're quite excited to get it going. Cheaper up front. The operating cost is about 1/3 of what a standard facility would be. So cheaper to build, cheaper to operate, more saleable products at the end of the day.
Well, I've been hearing that actually, ironically, CO2, like sort of industrial, medical, food grade, there's a shortage of that, and the prices of that are actually quite strong right now. I have no idea what the prices are, but apparently quite strong.
That's quite true. There is a global shortage, driven mainly by a field in the U.S. that has started to turn sour. It's a natural gas and CO2 field where the gas has turned sour. So tough to make food grade CO2 out of sour gas. So it's caused a major hiccup in that space. So luckily for us, we're able to capture any that we have, and this was always our plan, was to capture. But the fact that we can now capture and upgrade to food grade right at site provides us a monetary advantage over just re-injecting it back subsurface.
So all of your offtake product is going to be liquefied and put into trucks and trucked out of there. Is that the basic strategy?
Well, no, actually, the helium leaves our site as a gas.
Okay.
And we have to truck it down to a liquefier where it gets liquefied, and the customer picks up liquid helium. Now, in our contract, we've essentially sold it at our wellhead. So we look after the logistics of getting it down to a liquefier and getting it liquefied, but we don't have to pay for any of that.
Oh, so the client pays the liquid.
Client pays for that. Yeah.
Okay. All right. Okay.
So our price is essentially a wellhead price. Gotcha.
All right.
The other products, we're sort of working out that supply chain now, or that logistical chain now. It's a relatively new feature to our company. So.
Yeah, and relatively minor compared to the.
Yeah, absolutely. Yeah.
So a bit of a minor component. Can we discuss the CPR report or the engineering report, and can you maybe just sort of overview it and point out some highlights and dissect it up a bit here?
Sure. Well, we're quite pleased with it to start with. It's our initial. I'm going to use air quotes and call it reserve report, because it's not technically a reserve report, but that's essentially what it is. It shows that the project is profitable.
Sorry. There is no way to make a helium CPR report a reserve report. It just doesn't exist for helium. It's only for
That's right. So helium does not qualify under the provisions of 51101. So
yeah.
specifically excluded. So while this report was completed under the same methodology, it specifically is not a 51101. But all of the processes and all the procedures are identical.
Yeah.
The outputs are the same. It's just not that.
And it's essentially a bankable report where you can now take it to funders and say, hey, this is the engineering stamp of approval.
Exactly right. Exactly right. So we've done that here, and it focused on two primary areas. One, the Steveville asset where we're going to be building the facility for it, and two, the Nazare zone in Saskatchewan. So talking first about Steveville, you can see on the screen now that, on a risk basis, there's 138 million cubic feet of helium there, net of royalties, producing a median case value of a little over $22 million. We're quite pleased with that. That's obviously net of all the construction costs and all the royalties and OPEX. And so quite a profitable project, even when discounted at 10%. So we're pleased with it. It's not, Steveville was never going to be the biggest project we have. We acquired it specifically for this offtake agreement, and it suited us perfectly well in that capacity. So, and bearing in mind that the contract we have internally, we value it at well over $20 million, and that's again for 40% of the volume. So,
and that is like sort of a near-term smaller project to fulfill an offtake agreement, and that was kind of the point, and then helps fund the rest and sort of legitimizes you as a legitimate helium producer.
Exactly right. It allows us to establish a very beneficial relationship with a very significant offtake partner. So,
yeah. And I just want to, like, on the screen here, if we can go back to or on both of these where it says low, best, high. The best is kind of the best guess or the best estimate. That's not like the best deal. Those are the brackets on the low side, on the high side, and their best guess, call it.
Yeah, I mean, it's technically the median or the average of cases. So clearly we're inclined to view it more on the high side, but that's always the issuer's perspective.
Yeah. The P50 there versus the.
Regardless, at the best case, a very valuable project, and I would also note that the calculations in here are based off of the operating cost of a traditional natural gas facility, which is not what we're building, and so the OPEX of running our facility is materially less. So the actual NPV numbers are potentially materially higher. Once we rerun them off of the facility we chose, and there was a timing gap here where we had to get this report done, and so it was done before the final engineered package was awarded on the facility build. And a couple of weeks after the CPR was done, we finalized the deal on the facility, and the op costs all changed, but we decided not to go back and redo the CPR.
Okay.
Yeah. There'll be more on that. There'll be an updated CPR likely later this year, which will incorporate all of that. And we'll be able to trace through the differences.
Where are we in terms of the construction of the Steveville facility and plant? Have we begun construction? Have you issued the purchase orders for the equipment? Where are we at?
Yeah, right now we have production slots with the major suppliers, and we're just waiting for our time in that production timeframe for the long lead items. Mainly, compressors and master control units, these type of things. But we were ahead of it far enough that it does not jeopardize our timing on bringing the plant online.
Yeah,
everything is still lined up perfectly. We went with a local group from Alberta who as designer are going to build this for us. They do a lot of their manufacturing of parts by themselves in-house in Nisku, Alberta. So it's just a very, very interesting group who have a long history in building facilities and refineries in Alberta and elsewhere. So very qualified group.
All right. I sort of got a little ahead. I wanted to actually go back to the engineering report here. We looked at the Steveville, and this is the Nazare project here. And this is obviously much earlier stage. This is sort of a resource estimate, not an NPV with the economics, correct?
Yeah, that's right. So on Nazare, what we completed was essentially a helium initially in place number, based on all of the drilling and all of the testing that we've done. And it came in, right in the range of what we expected. Again, on the best or median case, it's just under 1.3 billion cubic feet of helium in place in the ground.
And just to clarify this table here, on the total raw gas of 222 billion cubic feet, that's the overall gas. Yeah, and then once you get your percentage of helium, that funnels down to, call it 1.3 billion cubic feet. Yeah,
exactly right. So the best way to get to the number is roughly 222 billion times 0.65%. Gets you down to this helium in place number. So, I mean, it is an enormous future resource. The reason that it's stuck in helium in place and not contingent resource is because we haven't drilled the production well to turn it on yet. So that would be a horizontal well that we'll hopefully be drilling in Q4 of this year. If not, then Q1 of next. As soon as we drill that, this should shift from helium in place into actual contingent or reserve and resource.
Gotcha. All right. And the timing on that
it's worth noting that whereas there's no straight line on valuation, but at Steveville it's 150 million cubic feet, and this is roughly 10 times the size. It's just a monster of a project.
Yeah. And then once that production drill goes in, then the confidence level goes up higher, and then you can actually put a proper estimate.
Yeah, the issue is not, is it there? The issue is how do you drill it and produce it? And obviously we've produced all the models and everything that we've done internally and in concert with the University of Regina to show how best to drill and produce this. They've used that, and they just won't take it to that next level until we've actually drilled that well.
Gotcha. Well, you've got a lot on your plate to do with the construction, the drilling, the horizontal well, and that takes dough. And so what are the plans for the funding? We've seen a short form prospectus pop up. You've got an offtake, which is maybe bankable, and you got project financing and maybe some royalties. So how are you going to what's the thought process, and how much money are you kind of budgeting right now? How much of this can you tell us?
Sure. Yeah, no, that's a great question. So I think the whole world saw that we put out a shelf prospectus a couple of weeks ago. It caused a bit of a stir among some because it qualifies $200 million worth of capital. But the important thing to remember with a shelf is that's just what you're qualified for. It's not what you're going to get. And we did that so that we qualified other products beyond just common shares, because we have no intention of funding any of this project development or facilities build through the issuance of equity. There is traditional project financing available for projects like this. It's the reason we signed the offtake before doing anything on the facility side. It's the reason we got the CPR in place before trying to finance the facilities. All of these things you need in order to have the proper discussion and engagement with more traditional facilities finance type groups, whether that be standard banks or even the BDC here in Canada, or further down the line into more secondary project financing lenders, of which there are many. And we've had those conversations now, and they're advancing quite nicely. Going through that road at first, it becomes very similar to how when we advance on the equity side initially. There's some education that goes into what is helium and why do we care about it, but showing them the economics of our projects makes that conversation very, very short. They see it. And now we're just in the finalizing who we're going to be dealing with and what the drawdown looks like on a debt financing. So equity is not going to be a player in our facilities financing picture. Now going forward, when we have wells to drill, we have more exploration to complete. Some of that will come in through equity financing at some point. So make no mistake, I mean, we're a pre-cash flow company. At some point, there's going to be another round of equity raised. I would suggest that given the current pricing environment, it's not going to be a lot. We don't need a lot. We can inch this thing along and continue to develop on a very rational path until we start generating cash flow out at Steveville.
On a project financing like Steveville, you typically can't do those 100% debt. You need a cash component to offset it. I know is sort of often in project financing, 60-40 split is kind of a bit of a rule of thumb. Is it kind of in that range? And are there other ways of non-dilutively getting the cash, let's say through selling off some royalties or something on it without having to tap the equity markets?
Absolutely, there are. So our discussions initially started on 100% financing and have worked their way down to sort of 80-20 or 70-30. No, we haven't come down to 60-40 yet, and I don't think we're going to have to.
Okay.
But that's still, a decent sized chunk of cash that's non-debt finance. But the nice thing about where we operate and the size of the land package that we have and the productive capacity of it is that we can place things like royalties, or we can affix royalties to facilities and fund them that way. There's a lot of forms of financing this development activity without equity.
What is, sorry, just as a refresher, what's for Steveville, the project total value project cost on that?
The cost for building a facility?
Yeah.
Well, $20 million Canadian.
All right. So, and then that would be done through a package of project financing. Yep. For other things like drilling, Nazare and other sort of corporate endeavors and so forth. Can you give us any indication on sort of next 6 months budget or kind of what you need to sort of move the ball forward?
For sure. So what we've got on screen here is what we see as the deliverables over the next year, basically. And we have a number of things that we intend to do before the end of the year. Specifically, we need to complete the testing at Val-Marie. We drilled that well in August, very successful drill. We have to go back and complete it now. The same thing at our Ogema site. We believe that the rights issue that we have there will be solved in very short order. So that's 3 wells that we are not accounting for in any of our CPR or any of these things that'll be completed, and we'll have actual production data for them by the end of the year. So those are pretty major items for us. Nazare well we have at the end of Q4 and into Q1. That's about a $7 million well. So that one will require some financing. However, we are in the position of having a number of warrants that are outstanding that will be expiring before then, that have been in the money essentially since issuance. Right now, they're marginally out of the money, but we expect those to come in, and that will fund the majority of that well without having to tap additional equity markets. So whereas we will raise some money, it's not going to be a lot, and it's not going to be something that's overly dilutive. So that's our plan. And then we have additional exploration wells to drill over at Steveville and Bengoff. We have applied for our initial license at Bengoff after having gone through a year-long environmental review that's completed now. So a lot of things to do, a lot of ways to finance them, and a lot of very accretive things for our shareholders, such that if and when we do finance it at better prices than they are now.
Gotcha. You've also announced a little while ago plans to seek an AIM listing. Often coincidentally with a listing comes maybe a financing. Could you just sort of flesh out the AIM listing, and does that sort of indicate a sort of a coincident financing that if the equity would go along with that?
Yeah, so the UK listing was sought for a couple of reasons, but the primary one is just additional exposure. In the UK, there was one listed helium company, and there was a large appetite for one that was actually advancing towards production. And so that's why we chose to go there. The size of that market is enormous relative to the Canadian market. It provides a lot more eyeballs for our story. Financing there, well, any financing we would do going forward would, of course, involve the UK side once we're up and listed there. There's enough appetite there to satisfy whatever we would need. It's more of a function of whether or not we would take it.
Yeah.
So I would suggest that the next time we go to raise capital, that there will be a split between Canada and the UK in terms of who's filling that. And again, the sole purpose of it is to generate additional liquidity, additional trading for our stock.
Yeah, yeah, and a much, like you're saying, a much bigger pool of capital in London.
Yeah.
All right. All right. I think we've hit the key points. Is there anything we kind of missed before we open it up to audience questions?
No, I think we've hit the high points. I mean, in the last 4 months, we've accomplished a lot. I mean, the offtake agreement was probably the most impactful piece of news we've ever put out. Given the partner that we're working with, the confidentiality around it is severe. We can't say all we want to say, but I think we've said enough for people to interpret who it is and whether or not it's a real contract, and it is. That contract, I should also say, provides for a minimum delivery, but there is no maximum under that contract. If to the extent that we have excess production, they will take it at the price we've negotiated. So very good partners, but that is the most important thing we've done in the past 4 months in my view.
All right. Well, let's we'll go over to the audience questions here. We've got a bunch queued up already. Firstly, how much gas/helium do you expect to produce in Q2?
Well, we will be in Q2. We'll be producing 15 million cubic feet a day of raw gas at a rate of about 0.41%. So it's about somewhere in the range of 50 to 60 MCF per day of helium, 5.9 helium.
Right. Next question. Does Royal have any plans to supply helium to non-space exploration users such as microprocessing manufacturers, fabs, semiconductor fabs, or healthcare users like hospitals for MRIs?
Yeah, absolutely. We're relatively agnostic on who we sell to. I mean, there's demand across the entire matrix of helium users and very, very serious demand from industrial gas companies. So it's an unfortunate reality that we do get contacted by, places where helium is not just, nice to have, it's essential. So health regions call us in desperate need of helium, and happy to supply these groups should they need a long-term solution. Now, they all have long-term contracts in place with major industrial gas companies. So it just speaks to the level of shortage in the world right now that even with those long and secure contracts, they still can't meet demand. So we're happy to fill those gaps where needed. Again, we are agnostic as to which industry component we sell to.
Your first, you've obviously the space offtake agreement. How do you see yourselves going direct to consumer with other supply, or are you going to work also in partnership with the industrial gas guys for them to be sort of just to feed it into their overall distribution? So you've got kind of a regular steady, and they, I assume, have basically unlimited demand.
Yeah, we're trying to pursue a mix, and we're trying to build a portfolio of offtake agreements that cover various terms and various industries. We want to make sure that we're somewhat sheltered from a shock in any one specific industry. So selling 100% of what we produce into the aerospace industry would, it'd be lovely, but it also exposes us to a fair degree of industry risk. So we would like to spread that around to different industries, and industrial gas companies are going to play a part in our customer mix going forward for sure. So.
All right. Are there any financial instruments that Royal can use to hedge price/unforeseen events?
No, there's no way to hedge helium price.
Yeah.
So we handle that through proper budgeting internally and just cash flow management. That's all we can do.
Are contracts typically are they floating rate, or are you kind of like, say, with the helium gas distributor, would it be sort of like 1 year contracts that kind of roll over and reprice, or do you go into longer contracts, or how would you like to sort of structure your longer term portfolio of offtakes? A bit of long-term fixed, a bit of variable, how to look at that?
Yeah, the short answer to that question is yes, which doesn't really answer it. But our first contract was we call it long term. It's around the 3 year mark. we want to feather that in with longer term and shorter term contracts. The way it seems to work in industry is for contracts like the one we have, that's a fixed price over the term. That's what we have with that contract. With industrial gas groups, they tend to be longer term agreements where the price is reset annually.
Okay.
So you come back to the table and renegotiate price on an annual basis. So that's going to be, it's going to be a part of our sales stream, but we do really like the certainty that fixed price contracts brings, especially now, given where pricing is.
Well, and that I would presume that's great for the project financing partners.
Yeah.
Even if whatever the price doubles, they know you've got a fixed sort of funding for the next 3 years to sort of ease risk.
Yeah, exactly. But that's also the reason why we don't want to contract 100% of our volumes under one fixed price contract, because should the price continue to go up, basically, if it continues to go up the way it is, we want to be able to capture some of that upside with some of our streams. So that's why we'll always maintain a percentage that we'll try to feed into a spot market to the extent it exists, or one-off shipments, but that'll be a low percentage. The rest is going to be sold off under contract.
All right. Do the low operating costs of the cryogenic facility depend upon guaranteed low electric prices? How vulnerable are you to electricity price increases?
Yeah, that's a great question. The answer is yes, it is somewhat vulnerable, but the power consumption of the cryogenic facility is, as I mentioned, it's the overwhelming majority of the op cost is power cost. And we're a third of what more standard facilities would be. But we do have the benefit of producing a little bit of methane at that site that we will be using for power generation as well. So we are a bit sheltered in that way. It's certainly the largest input cost, though. So to the extent that power costs go up by a large margin, so too will our op costs.
You mentioned that the op costs on the cryogenic facility and the CapEx are lower than traditional things. What's the trade-off? Like if it's lower to build and lower to operate, why aren't they all cryogenic facilities?
Well, that's a great question, and maybe they should be. But the reality is that most facilities are built by industrial gas companies, and they build a very good facility. Some of the groups that we had bidding on our project, like, make no mistake, they build world-class facilities, and they supply all the parts. This one was a step outside of the industrial gas space, and so we are taking that risk of building a facility without having an industrial gas partner to also take the gas at the end of the day. And we're able to do that because we already had a sales contract in place with somebody else.
All right. So someone is very curious in here. When will we know who the offtake agreement was signed with? Will we ever know?
No.
All right.
Not from us.
All right.
No.
Will Royal own or lease helium trailers, or will they be the sole responsibility of the third-party logistics companies?
Yeah, we'll likely lease the trailers, the gas trailers, to get gas from where we are down to where it's getting liquefied. But again, that cost gets passed through. So.
All right. Andrew says plans for the purification plant are approved and construction contracts awarded. Is it possible to know who are the current options to fund the $20 million construction cost per facility?
No, I think strategically that would be a bad move for us to say who we're talking to on financing the facilities.
All right. Oh.
And all these negotiations are behind confidentiality agreements anyway.
For sure.
Yeah.
Could you please explain the difference between Climax conventional and Climax Nazare? Yep. When referring to the resource that was 10 times the size of Steveville, were you referring to on these Climax projects or Nazare as a whole? Oh, I guess
Nazare alone. Nazare
okay.
alone. Yeah. So on top of Nazare, we've obviously got all of the more conventional formations above it. You can see on screen now what sort of the productive column looks like at Climax, where you go through more standard zones like the Dupereau or the Souris River, and below all that is Nazare. So Nazare is its own unit of production. So, and that's where the 1.3 billion cubic feet is coming from. The Souris River and the Dupereau are very productive zones in Saskatchewan. In fact, most of the helium production, we believe, is coming out of these zones, and the Deadwood, which is minor, just a little bit below. So that's a separate project as well. So, you know, these images here are from our 3D seismic program, and you can see we've got, you know, 20 drill targets at this small subset of the Climax project into the more conventional play, in addition to the 3 we've already drilled into them. So all of that, once we get them turned on, and I guess this is a good point to mention. When I talked about bringing a production facility to Climax, it is for the conventional asset. It is not for Nazare. Nazare is going to require a whole different beast of a facility, given the volumes that'll come out of those wells. So it'll be the Climax conventional that produces first. And then
okay.
Yeah.
Okay. Sorry, I shouldn't maybe ask you this, it's super speculative, but is, let's say, the Nazare going to be that much bigger than the other ones, or is the size of Nazare indicative of like how big the other 2 zones or layers could be?
No, Nazare will be much bigger.
Okay.
Much bigger. So, I mean, a good way to look at it is this, Martin. So the facility that we're building at Steveville is built to allow 15 million cubic feet a day of raw gas inflow.
Yeah.
At Nazare, our base case, or best case is the term they use here, the flow rates are, you know, 17 million cubic feet a day per well. So, and that's why I say it's going to take a different monster of a facility there. And so the way that development looks, the way we planned it out is such that we're going to have a mobile facility that we bring there next year to handle the upper zones, the more conventional.
And sorry, when you say there, those are the upper zones in Nazare.
Yeah. When I talk about conventional, I'm talking about Dupereau and Souris River.
Okay.
And by conventional, I mean those are going to be vertical well bores, unstimulated wells. Nazare is unconventional, meaning long horizontal wells.
Yeah.
Okay. So we're going to bring this 5 million cubic foot a day facility to Climax to process the conventional gas. At the same time, we'll get to building a permanent facility in that area to process both gas from the Nazare zone and the conventional. Once we have that in place, the initial facility moves off to a different project area and produces elsewhere.
All right. On to a question on funding. Is a UK listing dilutive to current shareholders, and by how much?
Only to the extent we raise money there. And if we raise equity dollars there, it's the same ratio as it would be raising money here.
Yeah. 1 million shares issued causes the same dilution, whether they're in the UK or Canada.
That's right.
Yeah. And how does Climax conventional fit into the production plans versus Ogema? I don't know how to pronounce that, following Steveville.
Yeah, so we pronounce it Ogema. That's how we pronounce it internally. But Climax conventional is number 2. So Steveville first, then Climax conventional, and then Ogema, Val-Marie.
And Climax unconventional, where does that fit on it? Do you have to, since that's the big kahuna, you got to build up those other production and cash flow and then to finally really exploit that, or?
No, we're gonna drill the first one again, Q4, Q1 of next year, and then if successful, which we think it will be, we'll drill the next one.
Yeah.
And as we're drilling the next one, we'll start construction of the large facility that we're going to need there. Okay?
And in the meantime, the first that's a production well, and that would be then the portable system would be used to process that gas.
Well, potentially, but it's probably going to produce at too high a rate, so it'll be drilled and capped until we have a facility that can handle it. So it's easy to draw, hard to explain with words how this flows out. So it goes Steveville 1, Climax conventional 2, likely Ogema 3, and then Val-Marie / Nazare 4. So that's sort of the way it's built out. The facility at Nazare, again, it's a longer term build. So I mean, it likely won't be completed in terms of a facility until 2024.
Okay. Yeah. All right. why was the CPR competent persons report done for Climax Nazare, but not Climax conventional? Will a CPR report be done for Climax conventional?
Yeah, so when we talked about when I was talking about the operating costs of the facility and how we'll end up getting an update put on the CPR report, all of that will be covered. So as will Ogema, as will Val Marie, all of these other assets are going to be rolled in at that point. So it was just, we had the most science done on Nazare, having spent most of our time there. Yeah. It was the easiest of them to do. So, and it was the largest. So.
And I think this, with my next question here, this graph or this timeline explains it, but estimate on timing for Val Marie completions and test results.
Yeah, Q4, the next 3 months.
Yeah. The first well at Val Marie was done in mid-August. Will the results be available soon?
That's all part of the completion and testing. So we've drilled it. The drilling went terrifically well. We have not opened it up yet, so we have not actually started the testing program there.
Yeah. All right. Have you signed a purchase order for the $20 million facility at Steveville?
Not for the full ticket, no.
But for some of the equipment so far?
Yep.
Gotcha. How much is space exploration contract, i.e. revenue for Royal, and how much revenue does Royal expect to make in the rest of 2022 and going forward in 2023? No revenue for 2022, is there? No
revenue in 2022. We'll essentially have 3 quarters worth of revenue in 2023, 40% of which will be made up by this contract. So it's, I think, around $7 or $8 million per year for the space exploration company's contract.
Yeah.
And then an additional 60% on top of that for the remainder of the gas. And we do have ongoing negotiations for the remainder of that gas stream. So selling it's not going to be a challenge.
So they're committed to taking 40% production. If they have the appetite, they can obviously, you could sell more to them if they want more, but they're committed to the 40%. So and they seem to have big appetite. So even like it gives you, I guess, some negotiating power when talking to other people as well, knowing that you already have a buyer in hand.
Yeah, there has to be a good reason for us to commit those volumes elsewhere.
Yeah,
whether that be at the same price but a longer term or a better price, what have you, or a strategic partnership of some sort. And these are one of the options that we've looked at is selling the other 60% of that stream to a user who wants to fund the facility. So a forward sale, basically. So all of these things are firmly on the table.
Gotcha. All right, we're a little off. We haven't touched this at all, though there've been a couple of news releases on this. Royal has found some economic lithium. What options are you thinking about, or anything that investors should draw from this? Are you taking the eye off the helium ball, or is that?
No, not in the least. Not in the least. So all we've done with the lithium is apply for the permits. That's it.
Okay.
So we tested for it in normal course of testing. When you test wells, you test whatever comes out of the well. We found this. We knew we had it for a long period of time. We didn't talk about it until after we'd made the application for the ground and the rights. And because we have competing rights in the same zone, we are the only ones that can be granted those rights. So we are not becoming a lithium company. We are a helium company. So to the extent that there may at some point be a lithium resource there, we will look to spin it out or sell it off.
All right. That makes a ton of sense. Another question on the construction facility. I guess it's what kind of news updates are we going to get on the new facility in Steveville? When will sort of news releases be posted at kind of what milestones?
Well, I think we'll announce once construction is formally started, like ground is broken.
Yeah.
There. I mean, it's essentially, the footprint is essentially laid out now, but And then probably just progress updates every couple of months.
Yeah.
Until it gets into commissioning time.
Okay.
Yeah.
How many production wells is Royal aiming to have in the next 3 to 5 years?
Oof.
And what's the vision for the company?
I guess there's a lot is the answer. We've got a million acres of ground to go and drill and produce from. At Steveville itself, 2 is the number. Those are the 2 wells that are drilled there are likely going to be enough to drain that reservoir. There is a sister project to Steveville called Steveville East, which we don't even show on the map here, but it is literally to the east of Steveville, which looks like a very similar type project. So another couple of wells there. But the inventory at Climax for the conventional wells sits at 20 right now. And on the Nazare side, there's no limit. So I would suggest that in a perfect world, if financing wasn't an issue, or if the cash flow was already in the bank to pay for it all, we'd be drilling 2 wells a month for the next 2-3 years.
Okay.
Yeah.
It's a lot of land, a lot of drill holes. Yeah. How many employees will Royal have, and how many are currently full-time staff?
So we've got 7 right now working with us. Mostly in Saskatoon, but we've got 1 in Regina, 1 in Kindersley, and then a couple out in Vancouver. As we continue to grow, there's the corporate team right there. As the company continues to grow and operations start, obviously you move operators in, well site operators to handle the wells. The facilities take, depending on what type of facility you're building, take a couple people to manage it. So it grows, and it grows relatively quickly, but it's all manageable. I mean, you don't need a well operator for every single well. We'd have, an operator for the Climax area, and then that person would likely have a cross shift, so that there's always somebody on shift. So
how many people will be, like, once you're up and running at Steveville, how many people does that take to operate?
Not many. That's a very efficient facility. So that's going to be, 2 full-time people.
Oh, wow. That's it.
Yeah.
All right. Question on the timing on AIM. It's kind of fourth quarter-y, but do you have anything more specific than that?
Right now, it's looking like early to mid-November for that to be final. It's been a bit of a process, but that's how it looks. So, I mean, we've got all the initial submissions in. There's some cleanup to happen along the way between now and actual listing, but we're being guided towards early November.
Gotcha. Are there any analyst reports on Royal right now?
Yep, there's 3. So Cormark Securities has one out on us, 8 Capital has one, and Hanneman Partners has one. So,
all right. Someone here asking about revenue and earnings forecasts. You gave some revenue kind of guidance for next year. Maybe refresh that, and any thoughts on earnings?
Well, I mean, we're certainly not going to give any earnings guidance officially, but I would suggest that the operating netback of our wells is about $350 per MCF, so exceptionally high.
Okay, and no one should be expecting dividends anytime soon. No. This is all going into, you're going to use any excess kind of cash flow to grow the business.
Yeah, it's all going to be plowed back into the ground, drilling additional wells and growing cash flow. And of course, you get to a point where cash flow far exceeds your need to continue drilling, and that's when the discussions around dividends start to come up.
Yeah. There were hydraulic stimulation procedures performed on both Climax and Ogema wells. Did they help the formation flow, or were they unsuccessful?
Well, they were successful. We did it at Climax. We didn't hydraulically fracture Nazare or Ogema, but we did at Nazare, and it did help. And that's in fact where we got all the data that we use in the modeling to determine how best to drill and complete these wells going forward, was the results of that frac.
All right. Is there potential for the cost of Steveville plant to match or exceed the lifetime revenues from the current Steveville wells?
No. Hard no.
Okay.
Yeah.
All right.
Yeah, again, the value of the 40% contract exceeds the total cost by a relatively safe margin. So
yeah, and if
that leaves 60% of the gas left to sell. So no.
Yeah, and yeah, that would be definitely a negative NPV if that were that case. It wouldn't make a. Of the 20 million facility at Steveville, what percent of that total spend do you have signed purchase orders for? People are trying to get granular here.
Yeah, 40%.
All right. I think you've addressed this, but any plans to do a 43-101 report on the lithium?
You know what? It's been discussed internally, and we're sort of determining, looking at sort of the cost benefit of doing that. Obviously, if you want to receive full value, if you're going to sell off that or partner with it, you're going to have to prove up some value. So 43-101 would make a little bit of sense. But again, it's nowhere near the top of our priority list.
Gotcha. Do you plan to do more 3D seismic over Climax? Previously, you had said that Nazare is constrained in size only by the availability of data. Could Nazare be much larger? Definitely
could. We will certainly be conducting more seismic as we go. It's gonna precede any future drilling. Obviously, we have it on our next 18 well targets. We've got 3D seismic coverage on it already. But as we continue to go inside of our existing boundaries, we'll have to shoot seismic along the way. No different from any other oil and gas company when they prepare to drill. All right, and I've got a doozy of a question for the final question we got here. And who's going to win the Stanley Cup this year? Well, boy, I got to be political about this. It won't be the Montreal Canadiens. I'll guarantee you that. All right. Otherwise, I think Colorado is still going to be tough to beat. All right. Well, we have finished things up here. Any concluding comments you want to make before we wrap things up? No, I just want to thank everyone for their time and their interest in what we're doing at Royal Helium. It's been a very busy 4 months, and we expect the next 4 months to probably be a little busier. We will have news coming out along the way, talking about how we're going to develop this company, talking about how our facilities are coming along, and talking about the results of the wells that we've already drilled. Bearing in mind that we're planning to start production from 2 wells in March, and we'll be testing 3 potential producers this year. So we've quickly moved from 2 wells online to potentially as many as 8 wells online within 12 months. So a lot of growth coming. Big plans, big plans. All right, Andrew, thank you very much for chatting with us today and answering all those questions. Have a great day. And yeah, we'll be watching the news flow and seeing how things progress over the next months. That's great. Thanks, Martin. Appreciate it. Cheers.